Hello, best ever listeners and viewers today, and welcome to today's best ever webinar, Priority and Profit, the Power of Preferred Equity. I'm Paul Mueller, Content Director here at Best Ever, and while we wait for a few people to trickle in, jump in the comments and tell us where you're viewing from today, and also knowing that we're here to talk about preferred equity, let us know what you'd like to get out of this. If you have questions at the top, feel free to drop those in the comments. There's a little bit of a Q&A section there that you can engage in, and if you have any questions along the way, drop those questions in there and I'll make sure that I get back to those at the end when we have a little bit of a Q&A. And with that said, today I'm joined by Darin Davis. He's the principal at Club Capital, an Austin, Texas-based real estate investment company that specializes in multifamily acquisitions, development, private equity investments, asset management, and public-private partnerships. And as I mentioned, today we're here to talk about the power of preferred equity. Darin is going to school us on preferred equity. The current debt and equity market has created an investor opportunity that hasn't been available in over 10 years. And with higher interest rates and tighter regulations among lenders, demand for preferred equity is rising, creating opportunities for issuers and investors alike. And in this webinar today, we're going to dive into the intricacies of preferred equity and how it gives investors a front row seat to returns, priority status, and immediate cash flow. So that's what Darin's going to walk us through today. He's going to show us why preferred equity is vital for ensuring the security and profitability of your investments in today's dynamic real estate market. So once again, if you guys have any questions along the way, feel free to drop those in the chat. And with that, Darin, welcome, sir. Good to have you here.
Hi, good to see you again, Paul.
Yeah, you as well.
You did really good on the intro. That was you need to come into the pref equity world. That was good. So yeah, all good. So no, I want to thank everybody for being on the webinar today because it's you mentioned it, but we do have kind of a once in a decade opportunity, which I think is going to last about 2 or 3 years. And for anybody that hasn't really been into the investing side of the multifamily in the 12, 15 years ago, they probably haven't seen much about pref equity, kind of what it is, what its function is, kind of how it operates. But we're going to dive into that because I really do think it's a great opportunity. And there's a lot of offshoots and what that opportunity can really be for you. So, but I think, if it is a little different, I'm going to start with kind of a data analysis of why the data is important in almost any decision you make. But then we'll get into actually what the pref equity is and what the opportunity is and what I think is going to happen over the course of the next 2, 3, 4 years.
Okay, perfect. While Sam brings up the presentation, there you go. Yeah, start off, Dan. Just tell the people a little bit more about yourself and your experience. What positions you as an expert in this space, obviously, and then you can take it from there.
Okay, I will. Well, and so obviously we just going to go into the pref equity. My background is I've got 20 plus years in commercial real estate. I started off probably like many, fairly small. Kind of went into some retail, some land development. Tried a couple single family homes back in 2001, 2002. Did not like that. I'm not saying it's not a great opportunity for some, just wasn't for me. But really hit the multifamily at the absolute perfect timing, 2007, 2008. And for anybody that was around in that financial crisis, that was probably about the worst time I could have picked to go into multifamily development, but I didn't know better and it all worked out. So it was good. But we are here in Austin. We do support developers and we do co-develop in the multifamily space. But we are primarily an investment group, a private equity. And we've been doing common equity, which most everybody is very familiar with when you're raising money through, let's just say, a syndication, and you couple that with the debt. We have done that for well over a decade, but we see this preferred equity opportunity right now. And this is something we want to share with everybody, whether you're doing business with us in Texas or you're doing business in Florida or the mid-Atlantic, wherever it is, these opportunities are out there. I just want people to be aware of them, because they're really good opportunities. So, and as you can see right here, we're going to talk a little bit about the data, then why the timing is so important, and really the simplicity of this, and then how we're doing it and why we're doing it. I think there's some key takeaways at the very end there. There's the mugshot, just so you can get that visual. We'll get past that real quick, but we'll move on. So let's talk about why the data matters. And you're probably going to, you probably already know most of what I'm going to tell you, because I think Texas, for the most part, has been in the national news with quite a few things on, corporate relocations and jobs and growth and taxes and we, through the pandemic, it really launched a lot of companies to rethink how and where they want to do business. And so what I'm going to talk about first is people, jobs, and companies, and why I think the Texas market, it's not the only market, but why I think the Texas market is still going to be a great opportunity for private investors like ourselves. But I think the first thing I really want to mention here is, jobs and people. If you look at this information from 2023, from 22 and 23 about migration from the United States Census Bureau, you can see that on the legend to the left, you've got a percentage change of 1%, 0.5%, less than 0.5%, and then you actually have some losses in migration. Well, if you look at the two states that I'm really going to focus on today, and we'll talk a little bit later about why we like them, but it's Texas and Florida. Those two states had a net migration to them that were 1% or greater. That doesn't sound like a lot, but when we look at some of the numbers, you'll see in comparison and just gross numbers, while that's significant to what we're going to talk about here in the supply and demand and housing and. Pointing that out, and if you look at the population change, we talk about net migration, that's actually people migrating from state to state. We're not talking about people coming from out of state, out of country. We're talking, California to Texas or, Texas to Florida. It's just the migration inside the USA. But if you look there, Texas and Florida represent about 800,000 gross net migration in last year from 22 to 23. And those two states are number 1 and 2, and they represent 58% of the migration numbers out of the top 10. Now, are they, the only states? Of course not. If you look at the ones there on the bottom, you're going to see a lot of what we call the South, the Sun Belt, Utah, Colorado being the two that are not more or less in the Sun Belt, but all the way from the South to Southeast coming through Texas, and then you come up around Colorado and Utah. Those are the states that had the most population gain, and we'll talk about why that's important, especially when you're looking at the U.S. becoming a renter nation and just the economics that those states provide. One other thing I want to point out, that here, this is just this past year, and Texas had relocation of 17 companies just this past year, and you can see where they're coming from. A lot of the companies are coming from California, and it's no secret that we're welcoming all Californians and all California companies. Even our Chamber of Commerce here in Austin, actually, and the state of Texas both, the Business Economic or the Chamber for the state. They actually did hard recruiting trips to California, and were very successful over the past 4 or 5 years. And I like that about our state. And I like that about the city we live in here in Austin. If you look at a macro level, Texas represents 55 of the Fortune 500, 24 in the Dallas-Fort Worth area as an example there. So Texas does lead the nation in Fortune 500, with California and New York being right behind it. And if you flip over to the right, and if you look at in 2020 and 2021, and you look at the amount of companies that relocated here, and we all know what was going on in 2020 and 2021, and it was really, companies were looking for a better business environment and a better business climate to do their business. And so many companies relocated here in those 2 years. That says a lot about our state and our economics, business climate here. Here's another one. We go into jobs and job creation. Nationally, you can see in 2023, Texas and Florida represented number 1 and number 3 in job creation. Again, at the end of the day, it comes down to jobs, jobs, jobs when you're looking at multifamily for us. So considering that 2 of the top 3 are Texas and Florida or in that Sun Belt area, that just bodes well for these 2 states. And I don't really see that changing anytime soon. The migrations and the jobs are still happening. Companies are relocating. People are moving here. And we continue to see massive relocations from companies here, massive compared to other states. Interesting, if you kind of drill down and look at the state of Texas, and you can see down on the bottom there, we have identified 4 groups out of the top 10 for job gains. The Dallas area being number 1, and the Houston area, the Houston and the northern suburbs, and then where we live there in Austin, Round Rock. And then towards the bottom there, you see that Fort Worth. If you add number 1 and number 9 together, that's the DFW area. The Dallas-Fort Worth area is just, it's massive, and it continues to grow. Companies continue to relocate there. That's why I put the Dallas group up there in the Fortune 500, because the DFW area has 24 of those, almost half, and the rest of the state of Texas has the other half. But that's where the relocation of jobs, that's where the business climate is, that's where the growth is, and that's where people are relocating to. Now, this is something I really want to spend just a second on, a little more in a second, but point out a couple things. And probably everybody's heard of this, we're becoming more of a renter nation. I mean, wages have not kept up with the cost of housing. And more people, and you hear digital nomads, or there's a younger generation, the group that's in that 21 to 35 range, that home ownership is either not obtainable today for them, or it's not a priority. And a couple of things that are happening here is, if you look at on the left, the total cost to rent an apartment here in Texas, and this is statewide, $1,380. If you look at that same number, or if you take that to owning a home in that same price range or that same demographic, you're looking at $2,195. Well, that's a delta. That's $815 more to own a home, and that does not account for taxes, insurance, and maintenance. So you add that on top, and you're probably looking closer to $1,200, $1,300, $1,400 a month difference from rent to own. And whether it's a lifestyle, or wages haven't kept up, or availability, we're seeing more and more people obviously not pursue home ownership, but are very comfortable with renting, which is creating a huge demand, and we still can't meet the supply needs. And I look at apartments today. I mean, some of the amenities in these apartments, I don't know why you would own a home. Some of them are absolutely luxury pools, gyms, everything that comes with them. I think the renter nation is here to stay and going to continue to grow. Now, let's talk about timing. And we talked about this a little bit on the beginning here. The pref equity, and I'll define what that is here in a second, but this opportunity has been created just recently. And I tell people, I said, guys, this is why you haven't heard of it, because the timing of this and the way the debt markets were and the way the interest rates were, there was not a need for pref equity. Everybody was doing senior debt, common equity. Well, fast forward to the last time we really had pref equity requirements, and this is 2008, 9, 10. Now you're 13 years, and now pref equity is coming back. And it really does fill a gap, but I still think that pref equity is not a long-term solution, but it sure is a short-term, and we'll talk about that here quickly. So if there's nothing else that you garner from this, information today, and if you haven't seen something like this, I'd be surprised, because it's talked about on every financial news channel almost every day. But there are $600 billion in loan maturities on multifamily happening in 24 this year, 25, and 26. And you can see it continues on out to 27. But what's happening here is these loans are maturing, and the problem today is that interest rates are high, leverage is low, and values are low. So what that's done is created this big gap. Okay, and we'll talk about this gap in a second and how pref equity fills that gap. But if I have a loan that started 2 or 3 years ago at 3.5% floating rate on my construction loan, and now that is up to 8%, and I'm at the end of my construction loan, you can imagine that delta of how much interest I have to pay on that. Well, if somebody was going out to refi that, the interest rates right now are still going to be 6.5, 7 plus, okay? And the values have come down because rates have gone higher. Rents have pretty much, in our area, have stayed either flat or a slight increase, but there's a lot of areas that are flat or slightly lower. So your valuations come down, which lowers your leverage, which interest rates are still high. So you've got this big gap. And we don't think the gap is going to last forever, as I mentioned, but I think that gap's going to be really significant this year, next year, and in 26. And this is where pref equity is going to come in and create a new opportunity for all of us. This is you could take this chart, and even though it says construction starts, and I'll talk a little bit about that for a second. If you look at that, at the 2007, 8, 9, 10, and you look at how low the construction starts were then, and if you do remember the financial crisis at that time, I mean, construction just about stopped in. I mean, we had a little bit here, but overall, you can see from the peak to the valley, it went way down. Well, if you look at 2010 all the way up to 2022, 23, you're starting to see this hockey stick effect. And what is happening today, and I don't think the market's going to be as, traumatic as it was back in 2008 and 9. But I think right now, if you look to the far right of this graph, you're seeing that we're in another valley inside of the peaks and the valleys of construction starts. And now we're almost down 70% here in Austin alone. So if you think about construction starts, and we did get really high in 22 and 23, there was a lot of supply being built, but we have literally fallen off the face of the earth when it comes to construction starts now. And what's going to happen is all of the supply that we created in 21, 22, 23 is going to be absorbed in 24, 25, 26, but no new supply for the most part is going to be coming online. And what you see with this hockey stick effect here in 2010, I believe is going to happen at the end of 2005, 2006. And why I bring this up is I was in the middle of 2008, 9, 10, and we actually put a product on the ground and opened it up in 2010, leased it up like that because 8 and 9, no construction. We leased 240 units in 6 weeks because there was no new supply. And we, again, as I told you in the beginning, I kind of didn't know what I was doing on development at that time, but it turned out to be really good for us. And as an investor, I didn't take advantage of those really low years as much as I could have or should have. But I can see what's happening now coming forward, and I'm absolutely going to capitalize on, the next 36 months, personally and, professionally, because I see it coming. It's repeating itself. And, I think it was Mark Twain said, I think it was something like history doesn't always repeat itself, but it sure does rhyme. And I see a big rhyme here. I think this is one last slide I want to talk about on supply demand and what's going on in our market, and our market being Texas and Florida. But you can see at the end of 23, up there on the top, on the dark line, that is the apartment demand. Okay, and you can see that we're still short delivering on supply. Now, those are going to start to even out over the next couple of years, as I mentioned, because we're really not going to be putting new product on the ground in 25 or 26, but we still have room to for the demand to catch up. But I think those invert each other in 26, and we're going to have far more demand, or the supply will probably catch up to demand here in the 26 timeframe, but 27, 28, I think we're going to have this big gap. And the last thing I'll point out, 12% of the demand is in Texas, and that is national. And that is significant when you look at, and that's all driven by migration and jobs. And I think that demand is going to continue to grow. So let's talk about why I call this safe, secure, and simple, because it is really a straightforward, investment for us. Compared to some of the other stuff you have to do, it's far simpler. It was simpler for us to execute on, and it's simpler for people to understand how it works. And I like and we'll talk a little bit about I think it's safer and I think it's more secure than a lot of other types of commercial real estate investments. But let's point out what the capital stack is. And this is most everybody on this call would understand what a capital stack is. Well, prior to 22, 23, a normal capital stack in our world for the last 10 years was what you see on the left under 2021, where you see the senior debt, which is to say we're doing a development or an acquisition, is the 75%, and then above that is the 25% of the common equity. That's a pretty vanilla transaction, pretty vanilla, structure for a partnership. Many partnerships are done that way. Well, fast forward to 2023, and you look at the senior debt going from 75% to 60%. Well, the banks have pulled back quite a bit, or the lenders have pulled back quite a bit on how much money they're willing to lend. They want more skin in the game. Well, you can see that now that the equity, the common equity, which is the most expensive equity for a sponsor developer, is now up to 30%, and that they can't fill that gap and make it pencil with putting 40% of common equity in there because they can't even hit the preferred return. They may get lucky if they can pencil out a 10 IRR. So what's happened is they're looking for this sliver of what we call preferred equity, and in a nutshell, all it does is it fills this gap. We call it rescue capital, and what it does is it buys more time for the developer to either execute on their business plan, meaning paying some additional expenses, going through stabilization, and they'll pay us a premium for that money. And what you see there on the capital stack is the senior debt's always first, and then the pref equity comes in and is second in line. So the pref equity will be paid prior to the common equity. So you put yourself in the middle of that capital stack, and then obviously the common equity is last, but you're assuring yourself that you have a far better return or probability of getting your money returned to you plus that interest than the common equity. And one other thing I want to point out, if you see that I put over there 20% greater return potential, as I mentioned just a couple minutes ago, the way things are penciling out today, if you're coming in at common equity, you're really lucky to be able to hit a 10 IRR. We have shelved every one of our developments for the last year and a half. We just said, you know what, we're not going to fund any of the new developments. We're going to wait until the market gets in a much better position. But I got a friend of mine that reached out to me the other day, had an investment, and we just talked through. He said, I want to compare your pref equity to this deal I'm looking at on a development. And it had great location, great demographics, great everything. And we just broke it down. I said, so what's your goal? And he said, well, I want to, keep my money and I want to make some money. I said, okay, I understand. I said, well, why would you go into a common equity deal that pencils out right now at a 10, 11 IRR, or you could come over here and you could be ahead of 30% of the equity, pretty much assuring yourself that you're going to get your capital back, or you're going to get the property with a deep discount, but you're going to get a 10, 12% return, and you sit above the common equity, and you're taking compared to common equity, your risk profile is way, way, way down. In fact, it would be very hard for us to go into an asset that we wouldn't be able to not only pay the senior debt, but we would more than cover the 10% of preferred equity. And he thought about it. He said, you're right. If I can get 12% on yours, I'm only getting 10% there. Why would I take that risk? Well, the only difference is there is no upside on the preferred equity. You get a guarantee or a contracted rate of return, and then you're out. So where the common equity gets a preferred return and then any upside on that. But, we looked at it and he looked at it and said, you know what? I'm more comfortable in this environment doing the preferred equity and having a contracted return rate. So you've seen this slide, okay? And I'm going to reiterate, and I want everybody to think about this in this 3-year window. This is everything right here. This is what's driving the issues that our industry faces today, and with development and maturing loans. And this is what's driving the preferred equity opportunity. Okay. I don't think interest rates are going to be significant. If they go down, let's just hypothetically say they go down 25 to 50 basis points. Well, it's going to be the back half of the year. And at the end of the day, 25 or 50 basis points is not going to move the needle. It's going to be sometime in 25. If you get another 100 to 150 basis points, then I think it's going to be impactful. But you still have loans maturing all of 24 and probably most of 25 before we see any real significant interest rate changes. But then you have to get everything else to line up, rents and insurance costs and. But, a lot of people are really focused on the interest rate. I don't think that's going to be an impact to anybody in 24, maybe some in 25, and it may be until 26 before interest rates, I think, really make a big part of what we're doing as a group in the multifamily space. So I want to put some numbers up here and give you an example of how we look at a deal. All right. So this is just a standard down the fairway type of capital stack. And this is actually a real deal here. But what I want to point out on this one is, how much pref equity and how much protection do we consider? Well, we would look at the total cost of the project, and we would say we don't want to be more than, we want 15% minimum to be behind us in common equity. We prefer 20 and we like 25, but all of that depends on where the asset is in construction or lease up, or where the asset is located, or the sponsor, or the terms that we can get. But as you can see here, the senior debt and the preferred equity represent 76% of the capital stack. So we have 24% of the capital stack, and this is the cost. 24% of that is behind us in common equity. So we're in front of that common equity as that extra safety net. And we don't want to over capitalize a deal. We would never take it up to, we would never take 15% as pref and maybe 5 for common. That's just not the way that model works for us. We want that surety of a discount should we end up not, if something were to happen, that common equity is behind us and it's something significant. Let's talk about the how and the why now. How we're doing this and why we're doing it. And I'll spend a couple minutes on this. But one, we're providing a solution to the developer. And these developers have issues with interest rates, rents, timing, a little bit of a hangover from the pandemic days, but that's kind of washing itself out still a little bit. But we're actually giving them a lifeline so that they can complete the project, complete the leasing, complete stabilization, hopefully let interest rates come down some, rents go up, figure out the supply and demand. And so we're helping them. We're also providing a solution for our investors, because I think a lot of the opportunities have not been there like we've seen in the past. In fact, where I used to get dozens of phone calls a month for us to provide equity, that's fallen off to virtually none. And the calls I get today are from developers saying, can you help us fill this gap? So we're providing a solution to our investors because the opportunity there is you're in a very safe, secure investment ahead of the common equity, and you're getting a rate of return that is contracted. And we'll talk a little bit more about how that rate of return works. Also, we look at every single one of these as we would own it. So we still go through a full underwriting, but all of that pre-development stuff and a lot of those unknowns with the development, we're not going through any of that. The loans have been issued, the guarantors have signed, the plans have been completed. We're not starting anything new right now. These are projects that are already under construction and close to being finished, or projects that are in the leasing stage that just need to buy themselves a little more time. And time can mean anything from 1.5 years to 3 years. So, but we underwrite these just like we were going to buy the thing as is or stabilize, so that we know we're in a good area, good location, good demographics. Talking about earning a safer double-digit return, most all of these for the investor are going to be in that 10, 10.5, 11.5 range that we will be doing payments to, earned out over that 2 to 3 year period. And those will be paid quarterly. So you're getting some cash flow immediately. That's something we heard from our investors. We're looking for something a little more secure than what the current or the market is showing us today. And we're also looking for cash flow. The other thing that I think is kind of the Trojan horse of this thing, in a positive way for the investors and the developer seller, is that we come in with our preferred equity. We're part of the team now. We're getting access to the property management, the project management. We're seeing everything about that asset, how it performs, and what that's going to do for us and potentially for the developer. We have a front row seat to this asset. And if you know most developers, and you've heard the term, merchant build, these guys are not in it to build it and hold it. They are build it, stabilize it, sell it. And their typical time frame is less than 4 years. So they're looking for a buyer. And if we're in there already and we see the complete asset performance and understand the asset, just like I said, we underwrite it to own. So if that were to happen, we could actually be acquiring this asset, most likely at least at a discount. And we could be helping the developer get out of this project so he can go on to build the next one and recapitalize to move on. But those are the 5 things we really like about it. It helps the developer, helps us short term on cash flow for our investors. And we think there's a great opportunity to pick up a handful of these over the next couple of years and do that cash flow and hold a little bit longer. So let's talk about this is I think a great picture just to show kind of what might happen should we be taking over the project due to the asset not being able to perform. And when I mean perform, if you look over to the left, one of the deals that we're working on right now, the cost to construct is going to be $250,000 at completion. Well, if for some reason, and this is not our business model to do this, but if for some reason the lender was not able to get a takeout or permanent financing because of their debt coverage ratio or their leasing or their cost, we in theory could take over the asset and the common equity would be out of the deal and we would own it for $189,000 per door. So if you look at that discount from $250 to $189, I assure you we can get a loan at $189 a door where the potential sponsor today might not be able to get it for $250 a door because they have to get it to pay us contractually or we take over the asset. Now the common equity is in a little bit different. They may or not be part of that, but in just kind of a black and white transaction, we could be acquiring that asset for $189. And if nothing else, if that doesn't happen, which that's not what we're targeting, if it happens, great. But you can see the protection that we have built in there with the common equity behind us. So this is an example of a deal that we have right now, and I think this is going to be pretty consistent going forward. We are looking at a 3-year opportunity here that's going to pay a 12.5% annualized return. Now, if you haven't heard this term, current pay, deferred pay, what we do is we have the developers escrow a certain amount of money to ensure payments can be made to the investors. And what we've done here is we've gotten 2 years of escrowed money at 7.5%. So the current pay will be 7.5% annualized, paid quarterly, and then the remaining 5% will be paid in the final year and at exit. So you are going to see cash flow from the current pay, and then you will see the capital repayment and the final interest paid in the 3rd year. But we did want to set it up where we had cash flow now, we had surety of payment, and that we are terming out at a period of time. And those periods of time, just so you know, will not go past the lender or the sponsor's loan agreement. So we're coterminous with them. So if their loan has to be paid off that day, we get paid that day. Now, they can pay us early, the sponsor can, but we usually put a minimum period in there, typically 2 years, because we don't want to fund and cover 1 year and just be right back out. It's not worth anybody's time to do that. But this is an example of what this current investment is, and which you'll see a lot of them from us going forward. And I think we'll see a lot. We're going to see 4, 5, 6 of these, I think, over the next 12 to 14 months, and probably 4 or 5 more the following year. That's what the pipeline's already looking like. This project, just so we are, this is a rendering, and it's in Denton, Texas, up in the DFW area that I talked about earlier. Denton is a suburb where I-35 East that runs through Dallas and I-35 West runs through Fort Worth. They converge in Denton. So if you know anything about the I-35 corridor, I mean, from South Texas all the way up to Canada, I mean, it is a distribution trucking bonanza. And Denton sits right in the middle of it. And the 2 universities, great, it's just a great place. And it's more of a bedroom community, but growing into the DFW area. And you have great access to the DFW airport and to downtown Dallas and North Dallas. So it's just really, really well located. For you guys that don't know much about us, I'll tell you a little bit about these numbers, and I'll be quick. That we, for the past decade, have done primarily development and working with developers that were merchant builders. So we would fund it, build it, stabilize it, sell it. And I think everybody knows over the last 10 plus years, it was a pretty rosy time for multifamily because of interest rates where they were. And us with the interest rates in Texas, we were putting as much supply out as we can. So that multiple was based off of developments that were more like the 4-year. I think this year and next year, you're going to see a lot of cash flow deals from us in that 10, 11, 12% range. So that number is going to start to change. We'll probably break it up into, hey, this is our development, and this is our, our common equity, and this is our preferred equity, because these won't be multiples. They will be geared to immediate cash flow. And that's going to conclude the presentation. So Paul, I'm ready to take any questions about pref equity or Texas or what I do on the weekends.
All right, great. Yeah, thank you for that. That was very informative, Darin. I've got a handful of questions here, and the first one is about the Austin, Texas market, or really, I suppose, the Dallas-Fort Worth market as well, and really Texas in general. And it's a lot of the conversation about oversupply in Texas right now, right? And I'm just really interested, as somebody like you who intimately knows Texas in a way that most of us probably don't. I'd really just like to hear your counter to that. I know you talked a little bit about what you kind of forecast, but I'm just interested to hear your thoughts on the nature of the oversupply right now and how you see that leveling out to the point where you're able to take advantage of it in those markets.
Yeah, No, that's a good question. I'm going to give you two answers. I'm going to take Austin and be fairly quick. We have 27 submarkets in the Austin MSA. All right. Half of those submarkets are absolutely oversupplied, and that it's going to take 2 years from now to actually catch up where that supply demand is much more favorable for investors. Okay. DFW has some of the same. I mean, if you look in the North Texas area, there's some oversupply there, no doubt about it. Texas as a whole, and if you remember that one graph I had there showing that supply at the end of 23 was still lower than what demand was, those are going to really even out 24, 25, and that's why we had construction starts going way down. So this is exactly why we're not going into the development or common equity world right now. This is the opportunity for us because we're going to go in and help those guys get through the next 2 years with a cash flow, contracted return, and we're gonna make money in this deal, hands down. Okay, and there is an oversupply, but I don't see us getting back into the development world unless there's some really unique opportunities and there's some really unique zip codes that are still undersupplied. That might happen for us, but this is exactly why we're in pref equity because statewide, yeah, there's a lot of opportunity for this pref equity to come in and help.
Yeah, I'm glad you mentioned that, Darin, because one of these other questions that I have here is that when you're targeting this pref equity, are you targeting? I think the deal that you just showed us is a development in the Dallas Fort Worth area. Are you targeting specifically developments or acquisitions or both? And if acquisitions are a part of that, is there a particular class that you're looking at?
That's another good question because we're being very focused. Okay, so we understand the development model and we've worked with developers and the issue. And so to answer the question directly, I'll tell you why here. But we're working with more or less Class A new construction, and it's either just completed construction or about to complete construction, because those are the guys that have. If you look at where they are, their loans are maturing in the next year and a half, and they're getting the pressure to get this project completed without having to go out and do capital calls and member loans and. So that window is what we're really trying to capitalize on.
And Darin, when I invest in preferred equity, I mean, how certain am I? How certain am I that I'm going to get my capital and returns?
Yeah, and that's what I think that's important to understand because you remember that when I was talking about the percent of common equity behind us.
Mm-hmm.
Okay, so if you have in the loans that we're looking at, the bank debt is 60%, and then the pref equity is 10, and then that 30 is behind you. Well, we're contracted that we get paid before that 30% of common equity. So if you look at where you sit there, is there a guarantee? No. Okay. But do we have the ability to come in and do certain things as the pref equity? We do. Can we come in and force a sale? Can we come in and do certain things? And not all contracts are the same, but we have some tools that we can use. But even if you think we're going to have a 30% correction on that asset, I think that's so remote that 16 million that I put up earlier would just disappear, and then ours would disappear on top of that. I think the entire market would be having significant Armageddon, if that was to happen. So surety, I love it because you are literally ahead of all the common equity. And I think we're in some really, really great markets. We're not in some random market, that there's no population, no jobs. And we're not dealing with, projects that we don't know exactly what's happening and we don't know the exact debt structures and timing and everything else.
Darin, you mentioned that you underwrite these deals as if you were acquiring them, as if you were developing them yourselves, even though you're holding off on development for the short term. Tell me about your underwriting philosophy and your underwriting approach in general.
Ooh, I need to go grab my major underwriter right around the corner here, but Yeah, we do a lot of research, and a lot of people use CoStar, but we also have a dozen plus resources in markets, and we use the major brokers, the Marcus and Millichaps, JLL, Northmark. We use those relationships. We use CoStar. We have a very very aggressive, meaning conservative underwriting approach that we use, and we double check, triple check, and because you can, if you're, put it this way, there were a lot of people that made investments off of pro formas. Okay, I mean just straight up pro formas, and there wasn't as much data research done, and a lot of those people today are facing some big challenges because a lot of the numbers that were presented without going through a massive due diligence, that's starting to not happen. We walk away. I'll tell you this: we walk away from, and you people, I think credible sponsors will tell you, we'll underwrite 20 deals and we might find one. Yeah. And we have two guys in our group that is at least 50% of their job day in and day out. And we underwrite the pref equity deals too, because we have to underwrite it like we're going to own it, because we may someday. I mean, that sponsor may say, you know what, I'm the last guy to get paid at the end, and I'm not going to get paid. Here's the keys. You take it. So if we're taking it over, and that could happen, I don't think it will. It could. We want to know that we want to own that asset. So we do. We don't invest in ones that we wouldn't want to own. Pref equity. We're not going to do a pref equity deal unless we thought we were going to own it. Or could.
Darin, Adam just chimed in the chat here with a great question. He's a Dallas Fort Worth West Texas investor, and he has a question surrounding deal flow. He says, "How do prospective clients know pref equity exists and know to come to Club Capital to find it?"
That's a good question, because I'll give you two answers. One, the developers that are needing the pref equity know us as a private equity shop, and they know that's our core business. So we have that network out there. Investors, this is why we're starting to introduce this concept now, because it has not been around in 10 years. And that's why I wanted to talk to you guys, and we're doing as much marketing as we possibly can. Actually, I'll be at Best Ever. And I think you guys I went to your one last year. I thought y'all did a fantastic job. And so I signed up day one, and I come in there, and hopefully I'll get to meet a few people. But it's not like pref equity is going away tomorrow. You're going to hear more about it, especially in the back half of this year, because the way that loans are being structured with maturities at the back half of this year and next year, there's going to be a lot of groups that are going to need some pref equity, and we're going to focus on it. And as long as you go to our website, and I think the link we have is clubcapital.co.co /best ever, and we're going to have some information on the kind of the definitions of pref equity and why pref equity and how it fits in to the deal structure. So we put a lot of good educational material out there for anybody that wants to get kind of pref equity 101.
Okay, great. And the last question I have here for you, Darin, is, obviously you're here talking a lot about pref equity, talking a lot about multifamily. What other industries do you invest in, and why?
Yeah, and I'm glad you brought that up, because there is another asset class I really like now, and I've had it personally for 10 years, and it's worked for me. But I'm looking at it, and we're looking at it from an investment standpoint for the company. But if you're familiar with triple net, and probably most of the people are on this call familiar with triple net. If you look at where we are on the I-35 corridor, when the whole pandemic started, and we figured out that 70% of our supplies were coming from somewhere else other than the United States, so all the offshoring. Well, not everybody, lots of companies started onshoring. Well, Laredo, Texas is where they're onshoring, connecting with Mexico. So that is the I-35 corridor. So what's happened here is you're having this significant growth in distribution centers and industrial all up and down I-35. And in San Antonio, I-35 goes north and south from, border to border, and the same with I-10. They cross right there in San Antonio, which is, more or less the heart of Texas. And the companies that are lining up there are credit tenants, new buildings, massive jobs are coming in there. And that triple net allows us to go into a deal and have immediate cash flow, fairly short term, probably 5 years or less. And then we have that upside on disposition. So what we liked about it was we have a credit tenant, new buildings, new properties, great deal structures, and we're getting immediate cash flow. And that the main thing we're looking at there is cash flow. And that this area continues to grow from, Laredo all the way, obviously through Oklahoma City for us. We're kind of in that area. But I like the triple net space for delivering really good, safe returns for the investment as a whole and the investors on a cash flow basis.
Excellent. Well, Darin, thank you so much for joining us today and giving us a little bit of an education on pref equity and the place that it should have in our portfolios. Everybody, like Darin mentioned, clubcapital.co/best ever is where you can go to learn a lot more. They've got a ton of resources to continue your education on this. Also, we're going to send out a replay of this webinar in an email afterwards. We'll include that link. We will also include a link to Darin's recent episode on the Best Ever Show, where he talked a little bit more about pref equity, a little more about Club Capital, and what they're doing right now and what they plan to be doing here in the near future. So I'll make sure we include that as well. Darin, anything else to leave the audience with before we jump off?
I would just tell everybody, first of all, thank you for the time. Look forward to seeing anybody at the event. But check your sponsors out, check your demographics out, check your data out. There's a lot of opportunity out there still. Just make sure you align yourself with the right people, because it matters.
That's great advice. Once again, thank you, Darin. We really appreciate it. And of course, thank you everybody who joined today. Be on the lookout for the replay and tell your friends about it. Have the best ever day.
Thanks, Paul.